Welcome to the Michael Yardney Podcast. In today's monthly Big Picture episode with Pete Wargent, we're going to be exploring a burning question on many investors' minds. Have the Australian markets bottomed out? Are we now on the verge of a turning property market? Now, despite 10 interest rate increases from the Reserve Bank, and that's seen the official interest rate rise 3.5%, property prices have not only stopped falling, but they appear to be on the rise. The peak to trough change in house prices was 9% according to CoreLogic, 4% according to PropTrack, and this is confusing some of those analysts who are looking for bigger price drops. They were suggesting there's going to be 15, 20, even 30% falls in property values on the back of interest rate increases. So today, we're diving into the latest data, the trends and economic indicators, while we also consider the broader implications for investors, homeowners, and I guess the nation as a whole. So whether you're a seasoned investor or just starting on your property investment journey, I hope you're going to get a lot out of this episode. So join us for the next half an hour or so as Pete Wargent and I discuss the factors that could potentially influence the future direction of our housing markets.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
In these regular Big Picture podcasts, Pete Wargent and I discuss the macroeconomic factors affecting our economy and our property markets. And a lot has happened since our last show a month ago. And I'm delighted to have the brilliant Pete Wargent join us again as one of Australia's most respected financial analysts and commentators. Pete brings his invaluable expertise to help us navigate the ever-changing landscape of the Australian property markets. So, hi, Pete.
Hi, Michael. The brilliant Pete Wargent. We'll have to have that intro again. Hopefully I can live up to the billing. Great to be on, as always.
Well, Pete, it's no secret that our housing markets have faced a fair share of challenges over the last couple of years, and each month we've been sitting here talking about them, the economic fallout after the COVID pandemic. Gee, I remember discussing that each month with you. It's 3 years ago now then it started. Then there were the 10 consecutive interest rate rises, and we sort of counted them down month by month, the lowest level of consumer confidence in decades. There was the continual conveyor belt of negative messages in the media that we talked about each month. But despite that, our housing markets have performed very strongly. They've faced considerable headwinds, but things seem to be changing now, Pete. Inflation seems to be falling. The Reserve Bank seems to have paused its aggressive interest rate rises, well, at least for now. And at the beginning of April, all the major research houses reported an uptick in dwelling values over the previous month, and some even for a couple of months in a row. So today I'd like to talk with you about, have the property markets actually bottomed out, and are we moving to the next phase of the property cycle? So maybe we start with the question, are rate hikes done? What do you think, Pete?
So just to sort of backfill where things are at. So you're right. So interest rates basically went to zero during the pandemic. Then we've had 10 hikes in a row, which took the cash rate target to 3.6%. And then just last month, finally, we got a pause, which I guess is the Reserve Bank taking stock of where things are at. I think the determining factor will be the inflation figures that are reported towards the end of April. So if you look at what financial markets are pricing and bond yields, well, they think we're done. There's no more hikes coming. And in fact, over the next 2 or 3 years, interest rates are expected to fall. There is every potential that we could get another hike beyond what we've had today. But it will all come down to where the inflation figures fall for the first quarter of 2023. So all of the indicators are that inflation peaked somewhere in 2022. But whether or not there's a bit more work to be done, we'll just have to wait and see on that.
Well, at the time of recording, the latest Australian Bureau of Statistics figures for the CPI haven't come out, but by the time people listen to this, they will, and will know what's happened to inflation for the March quarter. But in fact, that's going to be backward looking. If we talk about what's going to happen to interest rates, well, we know the Reserve Bank doesn't know from month to month. It decides each month, and they've said they're going to carefully watch the economy to make sure that it's not going to crash too much. But on the other hand, they want to keep inflation under control. But each of the banks have downgraded their levels that they think interest rates are going to get to. In fact, all the big four banks think there's going to be one more rise, probably in May. And then, depending upon which bank economist you're speaking to, Pete, they're suggesting interest rates are going to fall. The money markets have also factored in no further interest rate rises, haven't they?
Yeah, so I think when you're looking at financial markets, I guess a good way to think about that is it's not necessarily a prediction per se. It's more like a weighted average of all the viewpoints and all the possible scenarios out there. So it doesn't necessarily follow that if markets are pricing for interest rates to fall in a certain month or over a certain time horizon, that doesn't necessarily follow that that will happen. But as you said, they tend to be a pretty good indicator over time of where things are expected to go.
I think they're more indicating what's going to happen in the future. I agree with you. They've been very wrong up to now. And the money markets are really working on arbitrage, aren't they? And the banks, well, they've not been particularly good at predicting interest rates, have they?
It's been actually in many ways an unprecedented 2 or 3 years, with things were ticking along very nicely in 2019, then suddenly global pandemic, and it just threw everything out of kilter. Some lessons to be learned from that in itself. I think the key thing is that the cash rate target where it sits today is clearly in restrictive territory. In other words, it's slowing things down. If you look at some of those indicators, like, for example, new home sales or job vacancies, well, those figures have all been falling for some time now. So I guess, it may well be the case that we do get another hike. But the important thing is the current setting is actually doing what it's supposed to do, and that's slow the economy down. It's slowing down people's spending habits. We're starting to see that in March and April. So over time, it will bring the economy back down to the kind of pace that we want to see. And it's just a question of how quickly now those inflation figures fall down back towards a normal kind of a range.
Well, the Reserve Bank believes that inflation's under control and going to fall, but they don't think inflation's going to drop to their levels that they're looking for, that target range between 2 and 3% until 2025. And the fact that they're prepared to wait for it to take that long, to me, suggests they're not going to go aggressively with interest rates. They think Australia's economy is slowing over the next little while and inflation's under control. And I guess they can see all that's happening overseas. They're a little bit concerned we don't fall into the same problems that some of the overseas countries have fallen into.
Yeah, I think an important thing about the monetary policy in Australia is that the Reserve Bank has a 2 to 3% inflation target, but it doesn't have to hit that every single month or every single quarter. The key phrase is on average through the cycle. So we had actually 5 or 6 years in a row where inflation was under target, but we weren't cutting interest rates aggressively to get inflation back up to 2%. The Reserve Bank was more than prepared to be patient for 5 or 6 years. Now we've had an overshoot. It wasn't really driven by low interest rates per se, though. It was more to do with lockdowns, border closures, international and state borders shut, global supply chain disruption. So it will take some time for those things to get back down now and to see inflation coming back down to 2 to 3%. But it doesn't have to happen immediately. It will actually happen quite naturally over time with interest rate settings where they are.
Well, despite interest rates having gone up 10 times, as you said, the housing market has turned the corner. Dr. Andrew Wilson and Louis Christopher from SQM Research, who've been keeping track of asking prices, already foreshadowed that at the end of last year, the beginning of this year, as asking prices, which are a leading indicator, started to turn. And then over the last couple of months, the three big research houses, CoreLogic, PropTrack and Andrew Wilson's My Housing Market, all showed a revival of our housing markets. Houses and apartments, price rises went up. But clearly people are now asking then, well, interest rates have peaked or getting close to it. Housing prices have moved up. Have we actually reached the bottom? And I guess in my mind, we've got to remember that there isn't one property market. So even if we're talking about a Melbourne or Sydney or Brisbane market, there are apartments, houses, townhouses, inner city, outer suburban. And the bottom isn't a day or two or a week or two, is it, Pete? It's actually a process, a period of time. have we reached the bottom in some areas? I think we have. The market's turned, particularly in the upper end of Sydney. In other areas, I think we're still going to see some price falls.
Yes, I think that's it. I think prices are rising, but not everywhere. I think if you were somebody who is buying property, I think the best or the most favourable buying conditions were some period around late 2022, because people were still absorbing rising interest rates. Bank economists were forecasting, in some cases, the cash rate target to go well above 4%, which was causing some conniptions and consternation. That fear factor has kind of gone away over the last few months. If you look at what money markets are now pricing, if you look at the tenor of the media headlines around housing. So I think in that sense, yes, the market bottomed sometime in late 2022. I think though, if you sort of drill down, and I know this is one of the things you do in your wealth retreat course, just to give you a bit of a plug, but it's to do a bit of a drill down to some of the sub-regional and suburban level. And you'll probably find actually that a lot of regions in Australia and also for B and C grade properties, well, they're still struggling a bit in certain parts of the market. So yes, in the capital cities, in those investment grade properties in suburbia, prices are clearly rising, especially in Sydney and Melbourne, but it's not really happened across the board yet. It's not a fear of missing out or anything. It's just a steady recovery so far.
Well, what's happening is that there are a number of factors, not just interest rates driving our markets. An important one is consumer confidence. Another one, of course, is supply and demand. While overall consumer confidence is still low, Pete, I'm experiencing at Metropole, we're experiencing lots more buyers factoring in, okay, there may be one or two more interest rate rises, but I've got to get in. It's not a fear of missing out. They're not in a rush, as you say, but they're wanting to take advantage of it. And I guess there's also the surge in migration, the return of international students, and the fact that we're just not building enough, can't build enough, and especially at the moment with builders going broke, the supply of new dwellings moving forward is going to be quite limited.
I think the supply crisis is going to be the main news story for the rest of 2023 as it relates to the housing market. So I know Andrew Wilson, who's a regular on the show, his monthly figures showing asking rents for units in Sydney up 37.6% over the year to March. And it's just accelerating, 7.5% in a single month. So there's nowhere near enough rental housing, particularly in Sydney, Melbourne and Brisbane. So again, it's not the same across the whole country. There's a lot of supply still being constructed actually across much of Australia. But if you look at the capital cities where people are coming to, so most migrants head to Sydney and Melbourne when they come to Australia, but actually internally people have been called back to the office as well. So there's a lot of pressure on those capital city markets. And that's going to be the big question for the rest of the year. Where is the supply going to come from, and what's this going to do to the rental market?
And all the new supply is going to be more expensive. Builders are now being very cautious about taking on new contracts. And if we talk about homes or townhouses, they're actually costing considerably more. Construction costs have surged around 25% in the last 2 years, and builders are passing those costs on to home buyers, and that's impacting the value, the price of new homes. And most of the towers, the big apartment towers that we need to build to fill in bulk large quantities, to fulfill the requirement in bulk and large quantities for the migrants, they're just still financially unviable because end values aren't high enough yet. That's going to underpin value of apartments, isn't it?
Yeah, so the unit or apartment market has, generally speaking anyway, underperformed detached housing over much of the past cycle. I think that's changing a little bit, but with a caveat. It's mainly those, what we call investment grade apartments. Usually they've got a high land value content, the more boutique.
Family-friendly apartments.
Exactly, yeah. So 3-bedroom apartments or 2-bedroom apartments with some outdoor space in boutique blocks. Well, we're starting to see there's demand from downsizers. Rents are going through the roof, so first home buyers are coming into the market. And as you mentioned, if you actually look at the cost to build a high density development, maybe say 3 or 4 years ago, well, the costs are up about 50% overall for higher density stock. And the big problem we've got now is there are just no foreign buyers in the market to get that stuff off the ground, to get it financed. Previously, we got a lot of investors from mainland China, but with the current stamp duty surcharge settings, that's not happening. So there is no supply quick fix to happen here. It's going to be a lot of pressure on those markets over the coming few years.
Beware of unintended consequences. They've pushed away the foreign buyers. They've pulled out the welcome mat from under their feet in many different ways, and now we're paying the price. So people are now moving back to apartments. During COVID, clearly there was a move away. They wanted more space, but people are now trading space for place. They're wanting to be in the right neighbourhoods. They're trading backyards for balconies and courtyards, particularly in Sydney and Melbourne, to a lesser degree in Brisbane, which isn't as apartment-centric, is it?
Yes, there is actually a big shortage of medium-density dwelling types in Brisbane as well. It was kind of a rational response to a pandemic. Everyone wanted more space. Share housing in particular just went completely out of vogue. I mean, it kind of makes sense, right? If you're not allowed to spend much time outdoors or there are lots of restrictions, who wants to be cooped up in a share house with half a dozen other people? One of the other changes now is that most employers have not gone to fully remote contracts for employees. So most employers want people back in the office or back in their place of work at least for 2 or 3 days a week. So it's not really viable for everybody to live a million miles away, or let's say a 2-hour commute is probably the outer limit of what people can do. So that's causing a lot of people to move back from my part of the world. Noosa is very busy over the Easter weekend because of school holidays and families coming up. But actually, a lot of people are now leaving the Sunshine Coast and some of those lifestyle markets and heading back to places like Melbourne and Sydney and Brisbane.
Sure. Well, what's this mean for house prices? There's been a number of people who have been prepared to stick their neck out and suggest that at the end of this year, house prices are going to be higher than they are today. Now, I don't think anyone's suggesting a boom. The next stage of the market is that buyers are going to come back in, and similarly sellers are going to come in and put their properties on the market as they see the market moving forward. I think what's often forgotten is that sellers are in general buyers. Sure, we often think as property investors, but 70% or more of transactions are home buyers upgrading, downgrading, moving. So as more sellers come into the market, there's also going to be more buyers there. But usually the next phase of the cycle is the stabilisation phase, not a huge uptick. And we're coming into a period where there isn't an oversupply. Pete, this was a very unusual downturn. In previous booms, there was always that building boom and lots of new apartment towers, and then it flowed onto, in the downturn phase, a large oversupply. We actually didn't really have that. Yes, during COVID, some of the inner city apartments became vacant because overseas students went away, but we haven't had a long downturn phase. It's been around a year because there hasn't been that typical large overhang of apartments or houses.
Yeah, so this has been a very different cycle in that regard. So what we got was what was called the Home Builder Stimulus Package, and a lot of people took up the opportunity to build homes, but that wasn't really focused on any one capital city. It was kind of a nationwide building boom. But what's actually happened though, the supply to date anyway hasn't kept pace with the rate of immigration. So we've got a lot of houses still under construction. It was around about 100,000 at the last count. Now those figures are always 6 months out of date. The supply has been slower than anticipated to come online for a number of reasons. A lot of people couldn't find the trades. There was a massive shortage of building materials, not just in Australia, but globally. There is actually a lot of building that's been going on, but it just hasn't really kept pace. I think, as you mentioned, in previous cycles, particularly around 2011, 2012, we saw a big boom in the construction of apartments, which they probably take 2 or 3 years to come online. This time around, it's not really been the same thing. We've got a lot of construction happening outer suburban areas, regional markets, but the capital cities just haven't seen the supply. There is a bit of an overhang, but it's not really in the big cities where the supply is most needed.
Sure. So on that basis, it's likely that property values, just because of supply and demand, are going to increase. I know Andrew Wilson believes that at the end of this year, property values overall are going to be up 3 to 4%, particularly led by apartments outperforming houses because of affordability. Louis Christopher believes that unless there's something crazy happening in the world and interest rates go up significantly, he sees a 10% rise through 2024 next year. I know your mate Stephen Koukoulas is very proud that he's predictions were right and that other people's predictions of a 20-30% fall in values hasn't occurred. And similarly, he sees a slow but steady rise in property values by the end of the year.
Yeah, I think the thing to remember is that these indices are driven really by Sydney and Melbourne, largely. That's about 40% of the housing stock, and by value it's actually more. So, yes, I think if you look at the national indices, they will be higher over the next 1, 2, 3 years. But I don't think prices will rise everywhere. I think borrowing capacity, if you actually rewind the clock to when borrowing capacity was at its strongest, it's down by probably 30%. We've also got a handbrake on lending at the moment. So the regulator, the prudential regulator, APRA, has introduced an extraordinary 3 percentage points buffer. Now, it said last month the buffer will remain in place because interest rates could still rise in the future. But I think it's becoming increasingly clear that we're either at the top of the cycle for interest rates, or if not, we're pretty close to it. So at some point, APRA is going to need to release that buffer and let people borrow again. And we've got people living in car spaces and tents, and we've got tent cities popping up, regional Australia, capital city Australia. At some point, they're going to need to let people start borrowing again to get some supply happening, particularly for landlords. So I think we'll probably see, yes, the indexes will rise because of Sydney and Melbourne, but I think actually a lot of parts of the country which got overcooked or overheated during COVID, some of the regional markets, well, they may well not actually recover quite so quickly and prices will fall.
I'd agree with that. A lot of it's going to have to do with consumer sentiment, how buyers and sellers feel, partly about their own financial situation and what they anticipate the future is going to hold. I think with regard to their own financial situation, most people are comfortable with their job situation. They can get a job, and if they don't like their job, they can easily swap to another one, and wages are starting to rise. So I think once they're comfortable that interest rates are not going to go up much more buyers are going to get in the market. And I know you do a lot of research every day on Twitter. You pass on a lot of information, and in your daily blogs, you look at what's going on. And same with us at Metropole. We look at multiple indicators. So while we keep talking about property values increasing, there's a lot more to understanding where the market's going and what the market direction is. And as we keep saying, there's not one property market. I see moving forward it's going to be fragmented. Different segments are affected by interest rates and the cost of living and our economic challenges differently. And clearly the affluent suburbs of Sydney, which led the downturn just over a year ago, starting in January last year, of now leading the upturn. And I think that makes sense. The more affluent areas, populations in these suburbs, they're not hurt as much by rising mortgage costs. Many of them don't even have a mortgage. They're not hurt as much by rising rent or cost of living. So we actually analyse a number of different factors, and they're not all the same. There are what I call leading indicators, things that are going to point to the future direction of the economy. There are coincident indicators, things that are showing what's happening right here and now. And there are lagging indicators, and they're the ones that the media talks a lot about, interest rates, which have responded to changes in inflation in the past, a consumer price index. But when we're going to get that, it's talking about the previous quarter. Sure, now they're talking about monthly as well, the unemployment rate and property prices. The property prices reported, Pete, are really things that sold 30, 60, 90 days ago. Sure, the trends in these are important, but I actually like looking at the leading indicators to give us an indication of where we're heading.
Yeah, of course. There's an old quote in financial markets and investing that over the short term, markets are a voting machine, and over the long run, they are a weighing machine, which I think was either Charlie Munger or his famous sidekick. I can't remember which.
Yes, I remember that one well.
So I think the key point here is that the thing that will move the markets in the short term is really confidence. It's not just consumer confidence, it's things within that survey, things like time to buy a dwelling or time to buy a major household item, those kind of things. That's because the number of properties on the market, well, yes, it's up and down through the year because of the seasonal activity and so on, but give or take, the number of properties for sale doesn't change all that much. What really changes is people's confidence to buy a property, and the number of people in the market to buy can change a lot more quickly than the number of sellers, and that's why in the short term it's all about confidence. Now, as you mentioned, as investors we tend to try and take a long-term view, and that's why we try to look for suburbs and regions and landlocked areas where the fundamentals for the long term are really strong. So things like population growth, gentrification, aspirational areas, a limitation on supply and so on. In the longer term, those fundamentals will be important, but in the short term, a lot comes down to sentiment, media headlines, what people are saying about the market, what prices are doing, and so on.
And we see how quickly that can change. You don't have to go back very far. The beginning of COVID in March 2020, the market slumped and people were nervous, and clearly we weren't sure what was going to happen to our lives, our health, or the world, or the economy. But once the confidence came back, boy, did the property markets pick up. And the same happened in 2019. Remember that federal election? Everyone thought the taxes were going to change. The non-winnable election that Scott Morrison did win, all of a sudden there was a property boom again. Consumer confidence turns quickly, doesn't it?
Yes, and I think the number one factor at the moment is monetary policy. I think there's lots of sort of sub-factors below that we've talked about in part, but I think the thing that's really been spooking people for the past year is, well, how high might interest rates go? The more that we see the tone of commentary and also the language from the Reserve Bank starting to change, the more people will get some confidence that, okay, well, mortgage rates are obviously going to be higher than 2% because they were never going to stay there for too long. But I think once people start feeling more confident that they're not just going to keep rising, I think that's the number one factor which is influencing confidence at the moment.
Well, the Reserve Bank is going to come out with its next interest rate announcement in May. It'll be interesting to see what's going on. And I guess I read a long time ago there was a Chinese proverb saying, may you live in interesting times, but it wasn't wishing people well. It was actually a curse. And interestingly, we are living in interesting times. And that's why I enjoy talking with you once a month about these big picture factors. Now, I enjoy getting your blog every morning. I love getting your tweets. If others want to keep up to date with your thoughts as a thought leader in these areas, where do they find out about you, Pete?
Thanks, Michael. Daily blog is Pete Wargent Blogspot, and you can also find me on Twitter, as you mentioned, at Pete Wargent. Oh, I'm easy to find these days. PeteWargent.com, lots of places.
And if not, you're on the golf course. You're having a lot of fun at the moment, and you're teaching your kids golf as well, I believe.
Yeah, that's more of an Instagram thing, but I do live at Noosa Springs, so the kids are dragging me out most mornings for golf school. So, yeah, it could be worse. They definitely enjoy getting outdoors and enjoying the nature.
Well, we're recording this with you in Noosa and me in Melbourne, but very shortly we're going to be catching up at Wealth Retreat, and by the time people listen to this, it's almost certainly going to be too late to join us, but put it in your diary for the end of April 2024. We get together once a year at Wealth Retreat. Look forward to seeing you in person then in our next Big Picture podcast in a month, Pete.
Yeah, can't wait. I think this will be my 9th Wealth Retreat. So always look forward to that week on the Gold Coast when you can really get focused in on your goals.
Well, I love the fact that you, despite being a presenter there and having been there so often, you sit there at the back and you take copious notes and you work on your life. And it's really interesting because I remember some of the things we discussed 12 months ago, and they've come to fruition, haven't they? You've changed a number of things that you do compared to what you did a while ago.
You've mentioned a couple of quotes and proverbs, but I think it must have been Jim Rohn who said that success is really just doing a few things, a few simple things, but just doing them exceptionally well. And that's really been the theme of Wealth Retreat over the years. A lot of the stuff we just keep working on and keep improving, but the results that you see over a decade are amazing.
Yeah, that's true. Okay, catch up soon. Thanks, Pete.
Cheers. Thanks, Michael.
In a moment, I'm going to share my mindset message with you. But before I do, I'd like to ask you a little favour. If you got benefit from my chat with Pete Wargent and you don't already subscribe to this podcast, on whatever podcast player you're listening to, subscribe to it now so you get our regular show twice a week, and once a month there'll be this Big Picture podcast with Pete Wargent. I was surprised to find out that there's lots of people listening to this regularly, but who actually don't subscribe. Now, again, in a moment I'll share my mindset message with you, but I think the message you should have been getting from my chat with Pete was that this nascent housing recovery, particularly in Sydney and Melbourne, has got legs. Now, don't expect any significant price growth for the rest of 2023, but 2024 is likely to see our property markets increasing as interest rates drop. Now, when that's going to happen, no one's sure. Is there going to be another one or two interest rate rises or none? No one really knows yet. It'll depend upon so many factors, but there's no doubt that the property markets are looking for a floor. They've found a floor in some of the areas of, well, there's not one Sydney or Melbourne market, as we've already said, so you've got to be selective. But this is the right time to plan. So while I can't forecast exactly what's happening to the markets, what I can forecast for sure is what's going to happen to people who get involved in property investment. And why can I say that? Because the statistics haven't changed over the years, despite the highs and the lows and all the information out there. I know that a lot of people who get into property investment won't get the financial freedom they hope for, and many will end up selling up within the first 5 years. And of those who stay in the market, less than 8% end up with more than 2 properties. 92% never get past their first or second property. Now, you've heard me say that before. So why do some investors do better than others? They make the right decisions. And in general, they make the right decisions because they get the right advice. So if you'd like to get the strategies and the frameworks that I've fine-tuned over 5 decades and that my clients at Metropole have been helped with for over 20 years, go to metropole.com.au. And don't be surprised if we don't start talking about property. We're going to talk about you, where you are, what you want to achieve, what your risk profile is, what you're hoping to do along the journey, and then we'll help put a strategic plan together for you. And then, if you allow us, we'll help you implement that strategic property plan. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Believe it or not, being wealthy is a choice. Now, I'm not sure that when I first read this, I really understood it. But when I did get the power of that statement, it made a big difference to me. Look, I probably read it in a book like one of Rob Kiyosaki's books. However, I do remember thinking, that can't be true. It's not that simple. You can't just choose to be rich. But then over the years, as I learned from my mentors, then I also studied the psychology of success, I discovered that Kiyosaki was actually right. And I was wrong. Yes, being wealthy is a choice. Over the years, I've learned that becoming rich begins with something as simple as the thoughts that you put in your head. Wallace Wattles first wrote about it in The Science of Getting Rich, and T. Harv Ekers tweaked the words a bit in his book Secrets to the Millionaire Minds. But they both taught me that your thoughts lead to your feelings lead to your actions, and your actions lead to your results. I'll repeat that again because it's important, because your inside world controls your outside world. Your thoughts lead to your feelings lead to your actions, and your actions lead to results. Of course, your thoughts are reflected in the vocabulary that you choose to use. So I've heard others put it this way: your thoughts become your words become your actions become your habits, and your habits become you. Because the words you use, the ones you use out loud, and the words you have in your head, you know, the little voice inside your head, they're pivotal points between the thoughts and your actions. The words that you use have a surprisingly profound impact on how much wealth you obtain. So I'd like to just go through 5 scarcity mindset phrases that I hear people use, and I'm also going to explain to you some abundant mindset phrases you could use instead. Because if you tend to use scarcity vocabulary, it's going to be nearly impossible for you to obtain real wealth. So let's run a little check on the words you use. Which of the following are more likely to say or to think to yourself? Number 1, the scarcity one is, I want to be debt-free. The abundance mentality is, I want to be financially free. You see, no one shrinks their way to wealth. No one ever got rich paying off their mortgage or paying off their car. So being debt-free isn't the answer. On the other hand, those who embraced good debt and used leverage to buy income-producing growth assets like residential real estate, they're the ones that developed financial freedom. Okay, the set of statements number 2. The scarcity statement says, live below your means. The abundant way of thinking is, expand your means. Now, I understand why people say live below your means. Sure, you must spend less than you earn, otherwise you're always going to be in debt. But the point of becoming wealthy is to live an abundant life and to be able to enjoy the good things in life, including giving back to your family and giving back to the community. So rather than living within your means, why not expand your means? Focus on production, not on reduction. Okay, scarcity statements number 3. I must work hard, or something like I must even make my money work harder for me. But the abundant way of looking at it is I must make other people's money work hard for me. It can be a stunning revelation for you to learn that getting your money to work for you will not create wealth. You just can't save your way to wealth. Instead, ethically employing the money of other people, of your tenants, of the government, of the banks, and now you have suddenly the ingredients for true wealth creation by using compounding and leverage. Let's look at another set of statements. One of them, the scarcity statement first, and then the abundance statement. The scarcity statement says, compound interest is magical. I'm sure you've heard that before, but abundant people think differently. Leverage is magical. As I said, you can't save your way to wealth. Even at a reasonable rate of return, compound interest only has a chance of providing you an adequate retirement when you get older. But it'll never give you real wealth. On the other hand, leveraging, using other people's money, gives you the return on investment from their capital working for you, not just yours. And this last set of statements I'd like to have a look at are, let's build a budget and stick to it, while the abundance statement would be, let's make a cash flow statement. You see, to me, the word budget implies frugality, scrimping, saving, cutting back. You can only cut back so much of your spending, and then you end up living a life that degrades the quality that you deserve. And it gives you a lifestyle of time wasted you'll never get back. Instead of sticking to a budget, I'd be suggesting you build a property investment portfolio that'll increase your asset base and in time deliver you multiple streams of income. That's going to increase your income potential, isn't it? Scarcity or abundance begins with your thoughts, begins with your words. So which life do you really want to design for yourself? One of scarcity or one of abundance? As I stated right at the beginning, you do actually have a choice if you want to become wealthy. Let me leave you with the last statement. A rich man digs for gold, while a poor man is concerned with the cost of the shovel. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney Podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney Podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?